really great topic for you today. I can tell there's lots of amazing interest. And we have a great group of experts today to talk to you about leveraging LIHTC and financing affordable housing. Everyone's number one question when they come to me and they're new to affordable housing development. So I'm really excited. Our hosts today, our moderators today are Maureen, Reichert, and Tim Anderson of RubinBrown. And I'm just going to go ahead and turn it over to them and get this party started because I know there'll be lots of questions.
Well, thank you, Joanna. Hi, everybody. Thanks for joining us today on this really technical and complex project that we're only going to touch a tip of the iceberg on, related to financing developments with low-income housing tax credits. It's a rather extensive program that started back in 1986 and has been the most successful and longest running housing program in the country to date. Over this time, it has basically built or preserved 3.7 million homes across the country and has served over 8 million families and individuals during that time. Each state has its own administration across the country for delivering credits and working with developers and investors to get these projects completed. And while we won't go into all the complexities of the program today, we did want to at least start the conversation on how to use credits to finance developments in your deal and how impactful they can be. We have two developers with us today, one local, as you all probably know, Ovation. Erik Sorensen and Lorri Murphy are with us today. And then also one of the national developers across the country, McCormack and Salazar, and with them is Dan Falcone and Joe Weatherly, and they are actually working first time in the state of Nevada with a specific project that they wanted to talk about today that's showing the impact to the community and also how they're working the financing on that. In regards to all of this, if you have questions, please feel free to enter them into the chat and we'll get the program started. I did want to first talk a little bit about how using the tax credit program, whether at the federal level or the state level or both, can impact your developments. And I just have a few quick slides to just show mainly how it impacts really high level your projects. And I wanted to share those with you today, and then we'll get into the moderated discussion. Let me share my screen here. So really quickly, I just wanted to provide a capital stack example. You may see this as a regular market rate conventional type project, and you'll see that it's going to take, $6.9, almost $7 million to build. And, you can get investors that give you $1.6 million. And you can get a construction loan for the remaining, basically at 5.3. Mainly what I'm going to show is the first mortgage line, which is, in this scenario, it's after everything is done, you're going to have a permanent first mortgage of $6.2 million that you will float on that project, and that debt load will be there. Now, if you take into account going through and getting subsidies through the federal LIHTC program only, you can have the same type of construction sources and the same costs, but if you start to notice, you will start to drop your mortgage down to 3.4. Your debt load starts to drop because we have limited partners that'll come in and buy those credits and invest in the project and in the communities that they impact. And we'll get into that in just a second too. And then if you add the state credits on top of that, again, it can drop your debt load tremendously again, and you'll have a federal, state LIHTC partner either together. They could be the same, or they can be different investors. But this is just an example to show how impactful the tax credit program can be to the financing of a project. And these tax credits are obviously affected by pricing from investors. They their market forces are driving that pricing. And a lot of it also has to do with community reinvestment that many banks and insurance companies have to follow, and their needs in making sure that they're meeting their what we would call CRA requirements. So the pricing can be affected by that, as well as, how impactful the tax rates are on various corporations. So that's just a really quick overview of how the credits can finance a project. And I'm going to pass it over to Timmy for any other comments, as well as introduction to Christine.
Yeah, no, that was great. So I'll leave any I don't have any other comments to add, but if there's questions later, we can always touch on that. But in addition to our developer guest, we also have a special guest today, who's Christine Hess, who is now the Chief Financial Officer with the Nevada Housing Division, and of course, the former Executive Director of the Nevada Housing Coalition, who is here to just give a brief overview of the Housing Division's role in housing finance and any other comments that you would like to add.
Yeah, thanks so much, Tim and Maureen. And, Maureen, I really appreciate how you showed the numbers and the capital stack. And I would just add, what is really important to the division, and I think for everybody in this call, right? When you're able to leverage that equity and have a project that costs more using these tax credits, what you are agreeing to in compliance are basically to have below market rents. So, when we hear about the high rent prices, these properties are required to have rents that are dictated, and we can talk more about that if we want, but they're below market. And then also they have in Nevada a 30-year affordability period. And that's part of the duties of the housing division. Our compliance team actually checks in on every property annually and confirms that those rents are what they're supposed to be, and the people living in the properties have the income levels that are restricted. So, so the Nevada Housing Division, I'm the CFO for the Housing Division now, and it's really great to be here. We are the state allocating authority for low-income housing tax credits. So if you're interested in the tax credit program, you're going to come to the Housing Division. We also have other funds that we pass through from our federal partners, in particular HUD. And from a development perspective, funds you may access would be the home funds or the National Housing Trust funds. So the biggest impact in terms of the number of units in the tax credit program comes through the 4% program. And that's through my office, by the way. So if you're interested in that, you're going to call me. But in order to access these 4% tax credits, at least 50% of the project must be financed with tax-exempt bonds. That's really a generalization. There's a lot more complexities than that, but just to give you an idea that you don't actually apply for 4% tax credits, you come to the division and apply for tax-exempt bonds, and those tax-exempt bonds trigger 4% tax credits that you build into your capital stack of equity. The states allocated these bonds based on population, annually receive 360 to 380 million. They come actually to the office of the Director of Business and Industry. So the Nevada Housing Division is one of 11 divisions that sits within the Department of Business and Industry. So it's actually our boss has purview over those along with the Private Activity Bond Council. But generally speaking, the last 5 years, the majority, if not all, of the tax-exempt bonds have come for affordable housing. They can also be used for economic development. So sometimes if we have a project like the train down south, we all get a little scared because that would really hamper the ability of Nevada to produce affordable housing. 4% projects are typically more than 100 units, right? On average, the division sees them about 200 units. So they're a lot. They're also at 60% of area median income. The other tax credit program that we'll probably hear about today is the 9% program. It's much smaller in terms of impact. Those projects are usually 30 to 50 units, but the income targeting can be a little lower, right? So they can serve household area median incomes between 45 and 50% typically is on average what the division is seeing. So that is a competitive program, whereas the bonds are first come, first serve. I am not going to take up more time than that. I definitely have a little bit more information and can talk about some of the challenges and especially in the 9% program that we're seeing, but I think we'll hear from the experts and get to see firsthand how this works.
Awesome. Thank you so much, Christine. And definitely feel free to weigh in on any questions as we go along too. Definitely love your input and perspective. The first question will head over and kind of aim it at Lorri and Erik, who kind of did a who we briefly introduced. Lorri and Erik, feel free to also introduce Ovation with this question as well. But the first one is kind of general. And can you talk a bit about your financing on some of your recent projects and any decision making in terms of leveraging resources like 4%, 9% that Christine was talking about, or other for other types of financing?
So if you don't mind, you'd actually asked us to talk about two questions, and we thought it made more sense to talk about the first one first. I mean, the second one first, which is
sure.
kind of how the current market is different from what we used to do in the past. So I thought I'd start talking about that, and then we'll end with our recent projects. And
yeah, feel free to kind of go into both.
So, and by the way, I'm Lorri Murphy. I've been with Ovation for 30 years, and I'm also currently the chair of the Nevada Housing Coalition, which is the great organization that's put on this luncheon learning.
And I'm Erik Sorensen, and I've been with Ovation for a little over a year.
So we have here three sample projects. And the first one is a sample 9% tax credit deal that we did in 2013. And the next was a sample 4% deal, a tax exempt bond 4% deal that we did when the market was pretty stable. And this is a current project that the way it would look, we don't have anything specific, but just kind of to illustrate how the costs have increased and the market conditions have made these a lot more difficult to get done. And I did want to start, Christine mentioned that currently the 9% deals are 30 to 50 units. When I first was in this business, they tended to be around 60 to 70 units. And they, at the time in 2013, they were really the only type of tax credits that we could do in Southern Nevada, because the market rents were not high enough to support 60% AMI, which is typically what you need in order to do a tax exempt bond deal. So at the time, tax credit pricing was pretty strong at 98 cents. The interest rates were about what they are today, but you can see the cost per unit was so much lower at $142,000 a unit. And one thing you may not realize is that what the smaller projects actually typically cost more per unit, because you don't have economies of scale that you get with the larger projects. And but at the time, these were the only deals that you could do. There were about 3 or 4 projects that could be funded in Clark County. It was a very competitive process. And again, the advantage is you can target deeper, but we could only do, a small amount of units per year. Around around 2016, the Housing Division stepped in with a new program called GAP, Growing Affordable Housing Program. And that they provided soft funds in the amount of about $3 million to projects. And that, combined with increased market rents, allowed projects to be done on a 4% deal. And then you could do, as Christine mentioned, the typical size that we do is about 200 units. And you could actually make those projects feasible. And the downside is your rents are higher at 60% AMI, but there's still a lot of need at that income level. And the advantage is you can do a lot more projects and produce a lot more units. And so on the 9% deal, you can see that about 80% of the project is funded by limited partnership equity. So you get a very small permanent loan. When we're starting to do the 4% tax credits combined with tax exempt bonds, the equity is closer to 40% of the total costs, and the mortgage is a higher percentage. The other thing that happens in these 4% bond deals is you have a very large deferred developer fee, which it's really, the deferred developer fee is actually a way to leverage tax credits because they're an allowable use, an allowable cost. So for the deferred developer fee, we actually can include them in the costs that allow us to get tax credits. So it's not really paid to the developer, it just comes out in cash flow, but throughout the project. But it's a way that you can get more tax credits for the project, so the community, the state and county and developer all can leverage those tax credits. So then the soft funds at the time, a typical project just needed the $3 million in GAP, which was an amazing program that made all the difference in the world, and home funds. And we used to apply for anywhere between, $1.5 million, then it started increasing slightly, maybe to $1.8 million for home funds. And so that's how you got all your sources to cover the uses. And again, even at that time, we'd already seen some large increases. Land prices are going up, interest is going up, and construction costs were already going up. Before I turn it over to Erik to talk about current day, I did want to mention one other program that kind of happened in between the two things I'm highlighting, and that was BLM land. We did do one bond deal or actually two of them in 2013 that used BLM land, and it was a very long process, but a process that takes over 5 years to get accomplished. But it enabled us to do two 200-unit projects between the free land we got from the BLM, and there was also a program called AHP from the Federal Home Loan Bank. Between those two sources and the fact that we got 95% discounted land from the BLM, we were able to do a tax exempt bond project even before the division came in with their gap funding. So now I'll turn it over to Erik to talk about the kind of what we're seeing in the current day environment.
Yeah, so one of the biggest things I want to point out is kind of self-evident, but the contribution towards total sources between the bond and the equity has decreased over time. A big reason for that is because the permanent loans because operating expenses have increased, making it harder to support larger permanent loans. That's one thing, while at the same time, your total development costs are going up. And so the need for soft funds has really increased. So the deal that Lorri was just talking about, we closed on last November, and it included 4 different sources of soft funds. And today, like this deal that we're showing as the sample current, a big contributor of that is CHF funds. So today, I'd say the biggest contributors of our soft funds are CHF and HMNI. But unfortunately, HMNI will be going away soon. So I guess in coming years, the ongoing struggles is going to be continuing to just close that gap, that soft funds gap. So yeah, in the sample current deal, we're getting 30% from soft funds. Let's see here. I put I mean, here's just some general trends that we've seen between the deal done, this crescendo deal, and today. Increased interest rates, that's increasing our total development costs, plus it's reducing the loan that we can size to. Construction costs are going up, operating expenses have been going up and not necessarily commensurate with income. Tax credit pricing, that was mentioned, that a lot of CRA, a lot of banks have tapped out their CRA credits at this point, and so they don't necessarily need to be aggressively putting the money out there. So our tax credit pricing has gone down recently. There are other things that affect tax credit pricing as well, but that's what we're seeing today. And land costs have been going up. So all in all, everything is really creating more need for soft funds to make these deals work. So yeah, that's all I got. Thank you.
Thank you, Erik and Lorri. That's a good summary of your projects. I would turn it over to Dan and Joe to talk a little bit about their perspective coming into Nevada for the first time. Specifically, Dan, just on the Desert Pines project, if you can describe a little bit about the project, the aspects of it. Obviously, it's a large land mass there and a lot of different phases and buildings going on. But what are some of the unique aspects of the project compared to maybe what you've seen on other deals you have helped consult with? And then Joe, for you, from a national perspective, what lessons are you learning here in Nevada, or lessons you've learned from other states that Nevada can kind of apply going forward?
Maureen, appreciate that opportunity. I'm going to share my screen here real quick. Hopefully, folks can see that the site plan of the Desert Pines development. For those that may not be aware, Desert Pines is an existing golf course operating in the eastern part of Las Vegas. It's about 3.5 miles east of downtown and City Hall, if to give people some sense of where it's at if you're not aware of it. And the golf course operator had an operating agreement with the city. They're terminating that. The economics of golf courses aren't what they used to be for in Las Vegas. So the city bought that back. City owns the land, and McCormack, Baron, Salazar, the MBS, was selected through a competitive process, and we're currently negotiating a development agreement with the city. The site's about 100 acres. So it's, a typically small site. I'm just kidding. Obviously a large site that, with the goal really and focus is to develop a mixed use to mixed income community with a variety of land uses. And right now we're targeting about 1,100 multifamily rental units and about 300 for sale units, along with about 80,000 square feet of commercial space and another 30,000 square feet or so of educational space. Combined sites include an early education center facility, a junior college training facility, hopefully. And so, bringing really together a whole community and making it work together. On the multifamily side, the goal is really to provide mixed income opportunities for working families. And we're going to agree and install affordability covenants that will range from 30% up to 80% of area median income for the affordable components, and then also do some mix them some market rate. All the unit incomes will be combined. Each block will have multifamily will have both targeted both market and affordable units, depending on its use, and be a variety of uses: housing stock for families, housing for seniors, also a product we call universal design, which is where every unit is fully built out and accessible. for residents. Overall, the for sale will most likely be all market rate. Affordability on that side is going to be provided through soft seconds. We've identified a few sources and organizations that can provide some soft second dollars to home buyers. And so we'll make sure that that's how we achieve affordability versus lowering the price on the homes, because we don't want to impact the neighborhood market pricing, and that's very sensitive to homeowners, obviously, and we want to keep that strong for folks. Some of the unique aspects to this really revolve around obviously project scale. That's one issue. Not 100-acre sites are not common. I'll put it that way. And traditional portfolio of affordable housing developers, McCormack, Barron, Salazar is unique in identifying and has a history of doing larger sites, and so we're very comfortable with that. And it's also one of the things that it makes a challenge to is how do you pay for all this infrastructure, right? You got to put in all the streets, utilities, roads, et cetera. So we're looking at leveraging in Nevada. They've created the State Infrastructure Bank, the Treasurer's Office, and so we'll be leveraging those programs and dollars to help provide all the infrastructure, and then ultimately come back and look for affordable housing dollars on the multifamily. Financially, we're structuring it to be the multifamily really to focus on leveraging tax-exempt bonds. Part of that is just scale, right? How many dollars will be available, and what can be achieved. We recognize that this is going to be a long-term build out. It's not going to be done in one day. It could be a 5 to 10 year build out program depending on subsidy sources. So we'll be coming to look for that, to leverage, very similar structural models to what was Ovation showed. That's a very standard model for a tax-exempt bond deal. One of the unique things that we find in Nevada is challenges that some people may find a 30-year covenant for affordability. It's actually relatively reasonable. I do a lot of work in California, and California has a 55-year covenant for affordability. So I would commend the state of Nevada for staying at 30 and keeping it there, hopefully, make things a little more viable, long term on the development side. And really creates the opportunity for developers to come in and partner. We're working with some local groups and trying to focus combination of what our expertise, what we bring, and then also work with local folks on their expertise to provide good quality housing and a strong community. With that, I'll Joe, if you want to talk about kind of the national perspective a little bit, so we stay on time and keep things moving.
Sure, great. Thank you, Dan. Maureen, how much time do I have here?
You have a few minutes.
All right,
3 or
great.
4.
Well, I'll go real quick. Couple things that Dan touched on, and I'm speaking from the perspective of a company that's been in business this is our 51st year. We've done this all over the country. The company was really a pioneer in mixed income and deconcentrating poverty going back to the early 70s. And we've attempted to come to Nevada previously in different times in different cities, and Desert Pines was really our first opportunity. We're also working with Southern Nevada Regional Housing Authority on development called Old Rose Garden, which we were selected for in the fall, and we're looking to close by this fall. We're very proud of that as well. It's nowhere near the scale of Pines. It's a couple miles away north, and it's going to be 192 units. We're very appreciative of that opportunity. But both of these have given us a perspective of the state in a short amount of time. I would say what we've enjoyed so far is Nevada's open for business. And there's a lot of states that have more roadblocks, more regulation, more hurdles to jump through. I won't name them, but there's a lot of them. And what we've really appreciated is the proactivity of everyone really that we've come in contact with. And I'm not speaking of just our design construction partners, those types of folks, but also politicians. I think politicians made these projects possible, making resources available, specifically the Home Means Nevada program. And I'm aware that it's also printed right on the license plate, which is fantastic. Setting aside ARPA money and being proactive and setting up different sections of the fund to focus on single family, multifamily, land acquisition. A very thoughtful program that we're certainly leveraging on these projects. And then also Dan touched on it briefly, but the infrastructure bank, that's something that we actually don't come across very often. We don't need it for Old Rose Garden, but we certainly need it for Desert Pines. And again, that's just an example of very proactive folks in positions of authority that are able to set aside these dollars. And one of the things that happened with Pines, as Dan's been getting it going, is you had a election and the governor changed, but that didn't change any of this, which is great. Your treasurer stayed the same. Zach Conine's been a really good ally for us in helping us getting this up and getting it going throughout the selection process. But I would just say we have been welcomed in with open arms by multiple groups of folks, not just the Housing Authority, the City of Las Vegas, Clark County, et cetera. We've attempted to go after some other things in other parts of the state, and we're hoping to have those opportunities soon. We're aware of the other BLM sites that are out there, and we're going to get after those as well. But one thing I would say, as far as our other states that we work in, we're in 30 states. We've got a pretty good perspective on this. I wish the other states were as business friendly as Nevada. It's been a huge, open door for us from the jump. And I would really hope that from the opposite perspective, that some of the other states we work in, and even those that we don't work in, would adopt some of the policies and programs that Nevada's done, like the infrastructure bank, like Home Means Nevada. It's just really been very helpful to us to have these tools. And also the city councilor for this district, Mrs. Diaz, she's also been a huge proponent of this. So going through this, we've just had nothing but open doors to us. And that's not always the case. This is certainly, Desert Pines is certainly an enormous opportunity, and it's getting off to a great start. And we're looking forward to getting a shovel in the ground and getting going. But I would just say the open doors, the understanding of impact, not just that homes are needed, but that they impact economic development, and drivers like that really are what drove us to the state. We're kind of data junkies when it comes to deciding what new markets to go into. It's real easy to focus on hospitality workers in a city like Las Vegas. That's kind of the obvious, but there's a whole lot of other people that live and work in Las Vegas, as all of you are very aware, in other parts of the state. So what we want to do is we want to bring a solution for transformation and help create more housing options, along with our colleagues at Ovation and others on the phone today.
Great, thank you, Joe. One last question before we wrap up to get some audience participation. With Christine also here today, we wanted to just get a feel for, with Nevada's growing population and increasing housing needs, how policymakers and the housing division and developers can work together to streamline the process and become more efficient in providing that affordable housing. If anyone has any thoughts on that between Christine, Erik, Lorri, Joe, Dan.
Anyone else? Lorri?
So I'm gonna have to ask you to repeat the question. I'm so sorry.
Basically, I wanted to just bring up the viewpoints and thoughts between Christine and you guys from Ovation, obviously, and MBS, related to streamlining the process, how policymakers and developers can work together to collaborate, what thoughts, perspectives could be streamlined to finance, more affordable housing in the state, given the growing needs.
Okay, sorry. I'm terribly sorry. So So usually when people talk about streamlining, I usually say wherever possible, and by the way, the jurisdictions have been great. And the housing division, I appreciate the comments, the MBS comments, because I agree wholeheartedly after working in Nevada for 30 years. We really do have very accessible local and state officials that makes it very, very friendly. But wherever possible, streamlining anything you can do concurrently instead of consecutively. So one of the things that holds us up sometimes is if we have to wait for an approval in one area before starting on the next. So if there's any time we can do those, there's a lot of paths either in permitting or various approval processes. So anything you can do to allow those things to proceed concurrently would help. Also, sometimes we get stuck with local officials not having signing authority. So making regional and local officials able to sign on some of these applications as much as possible would also help. And I'm thinking, the BLM is a perfect example. One of the things, a lot of it has to go up either to the state or sometimes out, nationally. And so wherever they can designate local officials, and even submitting applications. When you're applying to the BLM, you're not the landowner. So having a BLM official able to assign an application or having the local jurisdiction accept the developers signing based on a DDA or an application would also help. Yeah, I think I had one more point, but those are the types of things.
And I would say echo those components. Those are key things. A little step back, I would say, is maybe looking at some of the policy prioritization for the state. Right now, I think there's the policies and dollars are prioritized in certain categories, and maybe expanding that a little bit to put an emphasis on, for example, housing for families. And one of the key options could be looking at not just dollars per unit in terms of competition and effectiveness, but maybe dollars per bedroom. So that in itself would prioritize building some maybe 2 and 3 bedroom units, which for families would be more of a priority versus smaller units. So something to consider, and implications of that could trickle down back into the cities.
Yeah, one other thing, zoning, wherever you can pre-zone for multifamily or higher density, in master plan communities, or maybe do set-asides for affordable housing, any of that would be helpful also.
Maureen, did you want me to weigh in?
Yeah, if you would like, yes, if you would like to, if you have any thoughts on how the process is working thus far.
Yeah, I think, so I'm new to the state and to the division, so it gives me kind of that fresh eyes. One of the reasons why I came here is because the state is so responsive. And since I've been here, I can tell you the treasurer's office is fantastic, of course, love the infrastructure bank, and we'll actually had our first project approved at Board of Finance in December that included funds from the infrastructure bank. I don't think it's going to be easy, first one. Good news is you won't have to be the first one, but I am excited to leverage some additional resources. The good news is we're also, we work super closely with our local jurisdictions. I definitely see an opportunity for us to coordinate even better our application timing and processes. I can tell you that the division under this administration with the governor's office has been awesome. They reach out to us all the time. One of the things when the governor first took office is he said, no more, you have to get rid of some regulations. So the good news is, McCormack Barron, since you're new to Nevada, you're not going to be seeing more regulations, and certainly not coming from the housing division. And again, not to say that we don't want to be good stewards of funds and provide for the priorities that the community needs, but the division is able to be nimble and not have too much overlay in statute so that we can service our businesses the best. But we do have an excellent climate here and great leadership in this state.
Thank you. I'll open it up to some audience questions. I think there is one question here related to Rose Garden. Wanted to know what the impact to the homeless population would be.
Sure. What we're hoping is this will be a really nice new development for this area. One of our other colleagues built a new property across the street from us recently. I'm not sure of the year, it was maybe last year or 2 years ago. But what we're looking to do is revitalize that area with this particular property. We're hoping to create with this new housing options for folks to the extent that they are eligible and able to live with us. That would be fantastic. But as far as what else is going on in the neighborhood, we are very focused on our property, and we're hoping it has a very positive impact on the community in terms of the homelessness situation.
David Wallace has asked, what other soft funding or grant funding soft loan programs does Nevada offer specifically in Las Vegas that a developer that builds 100% with 60% units, how feasible, what kind of funding is there available for them?
I saw David had also asked about the breakdown of the 17.7 million for soft funds from our sample project. That 15 million of it from CHF. But there's also state tax credits. HM&I is going away, unfortunately. We've been using that quite a bit on our projects. Home funds still, and sponsor loans.
Yeah, those are just the types of things that could be used to make up that 17, the soft fund gap. But that's one of the hardest things is finding those vehicles to make up the soft funds.
We have a lot of questions coming in. So I think if everybody's okay with it, we'll answer a few more questions and run a little late like we do every month. There was a one early question that came in also right after David's first question from Melissa. When working on these projects, is there a single point of contact who informs your firm on these different programs? And how did your firm know how to assemble these various funds and tax credits to make projects pencil? Maybe you guys can talk a little bit about working with consultants, and RubinBrown, maybe you want to talk a little bit about what you guys do.
Well, from RubinBrown perspective, we come in and help with the financial piece related to modeling out projects, projections for how tax impactful they'll be, and what kind of financing is needed in regards to the project at hand. We typically come in before or really after awards are either made from a 9% standpoint, and the developers know that there's an award in hand, or from a 4% standpoint, they know that they're getting these bonds, and we kind of work throughout the entire life of the project, from the very beginning with all the projections and consulting and structuring, all the way through the compliance of annual audits and tax returns as required by the various regulatory agencies and Department of Treasury, obviously. And then also as the project comes to a close, with either exiting and getting the project either sold or re-syndicated, or an investor, may want to exit, and the developer keeps that project for a longer period of time. So we help on the exit analysis as well. From a consulting standpoint, we definitely do handle the financial piece. Ovation and obviously MBS can talk about like the consulting related to certain state programs, and just in general the construction and building and putting applications together for the state as well.
Yeah, I can say I've been doing it for 15 years, and we still rely on consultants, mostly because we don't have a staff that can handle, although we are staffing up and maybe eventually we'll be able to, but it's feast or famine in this business. And a lot of times all the applications are due at once. And so it is very helpful to have a consultant that, if nothing else, help you with the application process. Also, for example, we're doing a permanent supportive housing project, which is very new to us and also new to a lot of people in Nevada, in Southern Nevada. And so we got a consultant who works across the country for that as well. And I'm not going to plug anybody on this, but if anybody wanted to reach out for referrals, we'd be happy to provide some names. But this is very complicated stuff. And I would, especially if you're new at it, I wouldn't even attempt it without a consultant.
There's the first question. Thank you, everybody. There's that first question in the question and answer, Maureen, from Truckee Meadows Habitat for Humanity. Does anybody want to talk a little bit about using tax credits for single family home development? That is the question around if Truckee Meadows Habitat for Humanity could use the tax credit to build single family homes, and they build about 1 to 2 homes a year, but they have a current project at 21 homes.
Got it. Okay, so it looks like, okay, so yeah, Habitat for Humanity being a 501c3, they have approximately 1 to 2 homes per year.
Maureen, maybe.
Yeah, go ahead.
Obviously, the low-income housing tax credit doesn't work with home ownership because it's a rental program by definition.
Right.
But what has been utilized by other Habitat for Humanity chapters in the country, and MBS has participated in, has been the New Market Tax Credit program, and effectively created some equity that could be used to help buy down costs for homeowners through that New Market Tax Credit program, and then ended up being turning into long-term loans for the home buyers that were on soft terms that allows the structuring. So that's the strongest component of tax credit leverage that I've seen. But I'll defer to others if they know more of other things.
I would add in the division that we have had some 9% projects come through specifically for the tribes. And those were single family rent to own through the 9% program. We also are working, so probably Truckee Meadows Habitat, you'll want to reach out to me, but we're also working with Las Vegas Habitat for Humanity to understand how we can support them because their project did not meet the requirements of Home Means Nevada, for example, because there were initially low income thresholds that just don't make sense for home ownership. So it's a priority of the division, one that we've raised and the governor's office has raised back at us. How do we solve the home ownership challenge for so many?
Awesome. We do one more quick one before we wrap up. Carol Lehman asks if you have a goal of a percentage of homes that are accessible to people with disabilities, such as wheelchair accessible or braille accessible. So this maybe is for the developers on the call.
We look at having there's always the minimum threshold that regulations will require by the state or federal regulations, depending on your source of funding and fair housing laws. But we always look to do a complement to that. Somewhere in the 10 to 15% range is a challenge on some projects. But recognizing that, we'll do each phase, for example, at Desert Pines with affordability, but we'll build one building that is completely 100% fully accessible. And we'll set aside typically around 25–30% of those units for households that have somebody with some type of physical disability. And the remaining units are open to anybody regardless of their ability level, because we recognize that there is a shortage of accessible units throughout the country, and Nevada is not immune from that shortage.
And so we don't go quite that far, but we do always exceed the the requirements. For example, it's usually 5 and we frequently go up to 10%. The other thing that people may not know is that when you take federal tax dollars, you're subject to section, I think section 504 of the Fair Housing, which is stricter than regular fair housing. So you already have to go a little bit above and beyond. And all of the units that are not, that are on an accessible path, which in most of our buildings is most of the units are adaptable. So if anybody came into a project and there wasn't an accessible unit available, then they could move into one of the others and make a request for an adaptation.
Any final comments, Maureen and Tim, before we close?
Yeah, I don't think so. Just wanted to do a thank you to you, Joanna and Amanda, for helping definitely keep this all on track, and for all of our guests. Definitely always learn a lot from our side too, and definitely love to have these conversations.
Oh, thank you so much. We're so glad that you were able to join us today. This is obviously a very complicated and technical topic, and it's only a 45-minute session. So of course we will continue this conversation. You're always welcome to reach out to Amanda and I if you're trying to get in touch with someone, or you're looking for a consultant on something, or if I have a million resources from Elevate Nevada Capacity Training. There's lots of recordings on our YouTube. We have a Affordable Housing Finance 101 on our YouTube page, the Coalition's page, that I'd be happy to send out. We have a Affordable Housing 101 and we have Affordable Housing Finance 101. So we have many tools. So we'll send some of those out in the follow-up email with the recording. But thank you so much to all of our guests and speakers. And thank you for all of you for joining us today. We had a really large audience today. So now I know that we'll have to do a part 2, which I say at the end of every Lunch and Learn. So next month, we're going to be talking about water use and affordable housing development. I'm working on putting that panel together right now. So hopefully you'll join us again in April. And then, of course, our save the dates for our policy forums are in July, and our conference, as always, in October. So keep an eye out for all Amanda's beautiful communications on our upcoming event. Have an amazing afternoon, everybody.